Hey guys, I want to welcome you to the weekly Wednesday for the Financial Freedom newsletter, where every week, every Wednesday, we delve into something inspirational, motivational, something excerpt taken from the Financial Freedom weekly newsletter. Wherever you are, if you're listening on Spotify, on iTunes, Google, be sure to click the like, subscribe, share, comment. And without ado, let's get into the show. Hey guys, welcome to this week's podcast episode for the Financial Freedom Podcast. I'm your host, Dr. Christopher Liu. And as you know, I've always been in search of the top 0.1% mindsets, people on the cutting edge, the margins, living incredible lives outside of the traditional system. So today we're going to talk all about startups, fundraising, VC, and it's going to be a fascinating subject. I've always been interested in this field. And with that, we have Justin Renfro, and he is a leading expert in early stage fundraising. He's senior director at WeFunder, top community round fundraising, and he's going to talk to us all about that. So Justin, welcome.
Hi, thank you for having me. I'm excited to be here.
Yeah. Wonderful. Podmatch is a great place. Without it, I probably wouldn't be able to connect with leaders such as yourself. And so tell the people how you got started, what you do, and how your company works.
Yeah, so I actually started my career at a nonprofit called Kiva. Kiva facilitated $5,000 to $10,000 0% interest loans to entrepreneurs all over the world. And I launched Kiva in the United States back in 2012 and kind of got my start in the nonprofit small business space, helping entrepreneurs, that were very early stage raise that little buffer at the beginning of their, kind of company life cycle. From there, I actually started my own company. I own and operate a boat charter business in San Diego called Chill Charter. Done over $1 million in revenue, and we facilitate kind of bachelorette birthday parties out on the water in San Diego. Very good vibes. And I rejoined my core team at Kiva when they came to WeFunder. And WeFunder is designed to democratize startup investing, both for founders and investors. The key to WeFunder is that we allow investors to participate in startup with a smaller check size. So in angel investing, the basic premise is you need to make 30 bets. And your hope is that one of those bets takes off and pays for all the other bets. It's a concept called the power law. And that's what really drives venture capital is, if you're interested in investing, you have to make 30 bets. Now, WeFunder allows you to make 30 bets with a minimum of $100, $1,000, $5,000. So typically, with startup investing, there's a floor at 25K. So if you're going to make 25 bets at 25K, that can get expensive very, very quickly. It's like a guinea pig into venture capital. Whereas WeFunder allows you to kind of make a lot of smaller bets, learn lessons, and really understand kind of what do you look for? Because you learn a lot when you make investments. Let's lower that and democratize it so more people can participate in startup investing.
Yeah, very interesting. It's I've always been, basically, that one is going to be 1,000, 10,000x, you may lose. The others could be 500x, 10x. That's kind of how that's why I've always been interested in VC. And I love how you're fractionalizing everything, making it a lot easier, decreasing the risk, letting people get exposed to this, which was traditionally for, big players. I love that. And basically, the common question I get is, you have a company founder. When should they take VC and angel money, and when should they not?
It's a very good question. It's one that's changed a lot over the past year. In the middle of 2022, you kind of saw an explosion in a bad way. The funding markets across the entire ecosystem went down to a pretty considerable level across big VC, small VC. So I think that paradigm is actually starting to shift. I think that companies that make sense for venture capital have something called venture scale, which means they can grow very, very quickly. Scaling is not linear. So it's like you can
Mm,
double, triple year over year, and
mm,
there's a exponential growth curve. So from the lens of kind of like what do you look for first and foremost is you're making big bets, companies that can grow very quickly. And so I think a lot of venture capital is oriented around companies that can scale and have exponential growth curves. That's really the kind of like core premise of venture investing, is being able to invest in companies that are going to grow really fast and provide that 500x 1000x upside 10 years down the line.
yeah.
I'm 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 personally really motivated by this new product that WeFunder is rolling out called revenue based financing. A lot of companies don't fit into this venture scale model. There's a lot of healthy businesses out in the world that have a linear growth, they're healthy, the economics are good. They shouldn't be left out of the venture ecosystem, but the venture ecosystem is actually more narrow than I think a lot of people recognize. So
Mm,
WeFunder is actually creating a pathway. Normal companies, take a granola bar manufacturer, a CPG company, a brewery, where you can offer a 2x to investors, and it's liquid, so it's not based on an exit, it's paid back with revenue. So it's called revenue based financing. So you have kind of two different options, where if a company is on this venture track where they can be $1 billion business, I think venture makes more sense. But I believe that there's really cool funding models and innovation and opportunity for normal businesses that may provide a more modest return to investors, but it's
yeah.
liquid versus illiquid, and it's paid back in 4 to 5 years versus a venture investment that's typically not illiquid until an exit. And exits are not super common. So it's much higher reward, but also much higher risk. So it's kind of having different strokes for different folks, and that you have different options for how to invest in startups. It's not just invest in $1 billion unicorns. It can be broadened out to cater to different investor appetite.
Yeah, I love that. I know some people, they've heard venture capital go through like the process, because there's like there's like a there's series A, B, all the way up to IPO. Kind of illuminate that process for the listener.
Yeah, so any company is going to grow over time. And in the fundraising environment, we kind of simplify it by saying here are different stepping stones along the journey for any given company. So the first is pre-seed. That is capital that generally is coming in from the founder, their friends and family, people that they know. Then the first round of kind of like outside capital meaning angel investors, early stage funds. These are not friends and family, typically come in at the seed level. Then as the company grows, they kind of move up to bigger and bigger tiers in terms of funding. And then at Series A, you have a Series A, B, C, D, E, all the way until IPOs. Generally, companies are starting in pre-seed and seed, and then getting to like real institutional capital at Series A and beyond, all the way through acquisition or exit.
Mm, yeah, I love that. And yeah, it's so fascinating. It's like, especially with these hot companies, a lot of VCs, they try to get in and they can't, and it's just a fascinating game. So VC, I think what last year was, was really bad. What trends are you seeing in the venture capital space? In terms of, is it artificial intelligence? Is it blockchain? Is it metaverse, crypto? What are you seeing?
Yeah, the two biggest categories in venture capital right now is artificial intelligence and climate. Those are the two
Mm,
biggest categories that are gaining a lot of kind of interest and demand from institutional investors. So, obviously we've all started to see what AI is doing and what it could be capable of. So I think that there's a lot of startup activity in artificial intelligence right now. And the climate stuff is also very well known, kind of widely understood that climate solutions are relevant and important. So a lot of cool startups in the energy space as well.
Yeah. 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 Moving on. What are some common mistakes that early stage startups make when seeking funding? How can they avoid them?
I think investor fit is really important, where it's basically like if you have a venture capitalist coming to you to invest, do you fit their vision? Do are your visions aligned in terms of, hey, we want to grow really fast, we want to get to those next levels of funding, this is the aspiration, is to grow really fast and keep raising capital. I think that alignment in kind of the goals of the company and the goals of the VC is super important. WeFunder has a very unique vantage point in that we're democratizing access to startup investing. There's a lot of different companies, there's a lot of different flavors. Every time you talk to an angel group or a group of investors that are interested in this category, they have an investment thesis. They look for impact, they look for environment, they look for female founders. There's different flavors of like, where do I want to allocate the startup capital, what types of companies. And I think WeFunder does a really good job of kind of opening the gates and saying, like, there's a lot of options and you can kind of pick and choose based on your affinity, where it might be, I just want to invest in AI and make a ton of money. It's like there are companies like that on WeFunder. And then there might be companies where it's like, I want to support this cool brewery in Tennessee because I live in Tennessee, and like there's nothing wrong with that either. So, different strokes for different folks.
Yeah. Are you seeing this landscape of the traditional IPO landscape is also changing as well. There's like direct listing. There's also like SPACs. So how does our WeFunder fit within this changing landscape? How companies are choosing to raise funds, and then we'll go into how much funding to accept.
Yeah. So again, if you were to look at those stepping stones for founder, generally WeFunder is at the earlier stage before founders get to institutional capital. The nuance of how are we going the direct listing route? Are we going for an IPO? Are we going for an acquisition? That's generally later on. The early stage startup, again, higher risk, higher reward. They're raising at lower valuations and the upside is greater for investors. The earlier you get in, the higher your potential upside down the line. So there's kind of a risk reward fluctuation. WeFunder focuses specifically on companies that are pre-Series A, so pre-institutional funding. A lot of times, once you get to institutional funding, there's no access. So it's very hard for normal people and people interested in investing in startups to be able to get in on those deals. So your opportunity to get into those deals is generally in that pre-Series A phase. And that's really where WeFunder optimizes. If you're investing in a startup, I think it's important to understand what is the pathway for the founder to get to a liquidation for investors, whether that's direct listing, acquisition, or IPO. And that's an important question to ask if you're an investor looking at one of these companies, where it's basically like, what is the goal and what is the roadmap? From the founder's perspective, I want to make sure that's aligned with my expectations as an investor.
Yeah, really, really fascinating. And if you really know the landscape, if you have the right connections, you can really and you can raise capital for your investors, do very well. Like I said, it's a very fascinating area. As we come to the end, how much, I was always under the impression that there's no, more funding the better, but actually there's early stage startups, they need to determine the right amount of funding to raise and what are the consequences of over or under raising.
I don't think there's like broad strokes here. I think it's very individualistic in terms of like what makes sense for that company. The first question that founders should ask is, what are my aspirations and what is the goal? Because if you accept $1 million from VCs, the expectations are that you're going to dump money into growth and you're going to grow very fast as a result. That doesn't fit the roadmap or the philosophy or the framework for many startups, which again is where, it's like we're seeing in this current funding landscape different alternative options come up where it's like maybe it's not all about grow at all costs and like grow as quickly as possible. If you don't have product market fit, you can flame out and your company dies if you're not smart about how you allocate capital. And so I think that we're starting to see more sophisticated options kind of present themselves again for different types of founders, for different types of investors, trying to figure out how does the funding align with the vision. So another example in terms of the revenue-based financing, it might be my aspiration isn't to exit. I don't want to get acquired. This is my passion. This is something that I'm going to continue to do. The venture track where the only liquidation event is an exit doesn't make sense. Those companies can offer liquidity and a return to investors based on the cash flows of the business. And, it's like the way in which these deals are constructed are very individualized based on the aspirations of the founder and where they see their business in 5 years. If it's grow at all costs and exit, that's totally fine. But I don't know if that's the status quo.
Yeah, really great question. Great conversation. How can people contact you, follow you on social media, check out WeFunder?
Yeah, so on WeFunder.com, there's a lot of companies actively fundraising. You can go check out kind of like what does this look like in practice through realized examples and real companies that are actively raising capital right now. And you can find me on LinkedIn. My name's Justin Renfro, and I'd be happy to connect.
Yeah, and let's thank Justin for coming onto the show, talking about this the VC landscape, a lot of factors and considerations, really enlightening. All of Justin's resources will be in the links and show notes. And with that, thanks so much for coming onto the podcast.
Thank you for having me.
I hope you really enjoyed that wonderful, inspirational, motivational piece. Again, wherever you are listening, if you liked it, be sure to like, comment, share, subscribe. We're on everywhere: Spotify, iTunes, Google, Amazon, Audible. And without much ado, be sure to thank this show's sponsors, and we'll see you next week.